Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today we're talking hedge funds and commodities. The 2000s saw a plethora of very successful hedge funds dedicated to the space and a great amount of interest from institutional investors. However, post the global financial crisis, results declined, institutional investors exited the space, and it's been a rocky ride. With the coming commodity supercycle now, there's renewed interest again. Results are starting to tick up from the few surviving hedge funds that are still around. However, will the structural issues that led to a decline in performance in the 2010s continue to crimp earnings, or are we about to see a new golden age of hedge funds in commodities? And if so, where's the talent going to come from? Joining us to discuss is Ryan Duncan. Ryan is a managing partner at Bridge Alternatives, which is an independent introducing broker and FINRA-regulated broker-dealer. Ryan's been in and around hedge funds in the commodity space since 2002 and also manages the Independent Commodity Hedge Fund Index. Ryan, thanks for joining us.
Thanks for having me.
So we're going to, do a little bit of a historical walk through the performance and the hedge funds in the commodity space over the last 2 decades, teeing us up to discuss, obviously, what we expect now with growing interest from investors in the sector, what we think the future might hold. Can you just give us a really quick overview of some highlights of commodity hedge funds over the last 2 decades? I know you've got some numbers.
Sure. So I would say, broadly speaking, if you want to look at a few date ranges, so let's say, beginning of 2000 through the global financial crisis, through the end of 2019, and then maybe define our current period of 2020 and beyond. I think you saw extremely solid performance from 2000 through the first quarter of 2008. So if you look at the SocGen Commodity Trading Index, there's an average annualized return from that period of just over 23%, with a vol of just under 12%. Following that period, second quarter of 2008 through the end of 2019, I think it's an environment that really lacked a narrative in the commodity space and really lacked a broad opportunity set. Hedge funds returned just under 1% with a vol of about 4.5%. And then in the beginning of 2020, if you look at our commodity index, the Bridge Alternatives Commodity Hedge Fund Index, which launched in 2014, that has an average annualized return just under 18% with a vol of 6.85%, right? So I think you have, 3 distinct periods, one leading up to the global financial crisis, one from the GFC through 2020 or through 2019, and then kind of 2020 COVID era, and we'll see where this goes.
I mean, that's quite stark, isn't it? Because it also almost perfectly overlaps the last commodities supercycle peak and the trough, and then what we expect going forwards. And it's also a little bit hard to, tease apart some of the regulatory impacts and broader investing impacts of the global financial crisis itself. So I think we'll put a pin in that and come back to it. But that is a very stark contrast in performance between the 2000s and the 2010s. Before we sort of dig into some of the famous funds of the 2000s and try and understand a bit more about if there was any sort of trends around who was successful and who wasn't, which will be informative for the latter half of the conversation, can you just help us understand, get us all on the same page with the common language? What's the terminology around hedge funds? How do hedge funds compare themselves with others? What are the definers?
Yeah, so I think there's probably 3 different things to look at there. If you take the average annualized rate of return, and then the volatility of those returns, and then the Sharpe ratio, which would be the return divided by the vol, are probably the 3 metrics that investors look at the most. I think as it relates to the commodity space, I may add a 4th metric, and that being one of drawdown. So, I think the commodity space has largely been defined by hedge funds with outsized returns and more volatility than hedge funds in other asset classes. Broadly speaking, I think in hedge fund space, funds that are able to generate a Sharpe ratio of 1 or greater over a long period of time are generally considered to be in the kind of upper echelon of hedge fund performance.
Yeah. And just to dig into that drawdown comment, part of the underlying theme here is that commodities trade quite differently to other asset classes and are particularly defined by their volatility. And so all of these hedge funds have, in general, a higher volatility than other asset classes, and that drawdown requirement becomes quite a pertinent descriptor when organizations or investors are looking at funds, but also individuals and traders and so forth are thinking about whether they might fit in that fund.
Sure. So let's say, in aggregate, I would say the space exhibits higher vol than other hedge fund strategies. Now, that being said, there will be some hedge funds within the commodity space that target a lower volatility, and you have some hedge funds that target a higher volatility. I would say over the post-GFC period, you did see a number of commodity hedge fund closures. You did see some fairly sizable drawdowns that are really hard for institutional investors to stomach.
The other piece of terminology is also assets under management, AUM. Can you just give us some idea of how commodities as a class sits against other asset classes in terms of assets under management?
Sure. So I think by and large, relative to, long short equity funds, managed futures funds, credit funds, like the capacity in these strategies is quite low. So, I think if you're managing a diversified portfolio of commodity markets, your capacity is probably north of $1 billion. If you're looking to trade just a specific sector, you're probably looking at $1 billion or less of capacity. So something, we see managers in the ag space, their capacity is probably around 300, 400, 500 million. If you're trading energies and crude and related products, I would say broadly speaking, you're looking at a capacity around $1 billion, give or take.
Let's go back to the 2000s. You said at the top there that it was 23% annualized returns. Who were some of the major funds around in that period? Because there were some quite prominent successes, but also some very stark losses as well.
I started my career in the market kind of in the future space and in around the commodity space around 2002, right? So groups like Centaurus with John Arnold, Clive Capital with Chris Levitt, Armajaro with Anthony Ward, Ian McIntosh at Louis Dreyfus, Andy Hall at Aston Beck. I mean, these were large commodity hedge funds that had real institutional assets and, really grew to real investment management firms. Now, obviously, you had other managers with, lower AUM, but I think there was probably, I'll call it a dozen to a dozen and a half groups that really commanded and raised, a majority of the assets in the space.
What were sort of the common threads amongst those groups? And also, were any of them at that point digging into the physical aspect of commodities, or was these all purely financial trading plays?
Yeah, most of them were purely financial, but I would say, I think a lot of the PMs at those firms had a deep knowledge and network in the physical market. So either they had come out of places like Enron, or they'd come out of some trading house where there was a real understanding of the physical markets, a real understanding of who the market participants were. And I think, through that, they really had an informational edge over kind of pure speculators or pure financial derivatives traders who were just trading off of price, right? These guys knew where the physical was. They knew if there were going to be any disruptions in the supply chain and could express those views in the futures markets.
A lot of these PMs had come from the physical commodities world. What else was going on that kind of, I guess, was common to all of those major funds back in the day?
Well, I think in that bull cycle, there was really outsized returns relative to other strategies in the hedge fund space. And so I think you had institutional investors starting to make trips down to Houston to see all the gas and power groups, head out to London to see, some of the prominent hedge funds out there. You did see great performance and a real growth in assets. I would say, I think this is maybe more anecdotally, Paul, but some of those groups probably took in more assets than they could effectively manage in the market. So I think, as they take those assets in, they're able to deploy that risk. But, if you do have some type of supply disruption or a weather event or whatever that causes a real market shock, it became very difficult for some of those managers to get out of those positions. Then you had some pretty deep drawdowns.
Yeah, when you look at that list, though, there are actually very few, not many of those funds are still around, right? So whilst you had these great returns for that period, 2000 to 2008, suddenly there's lots of losses. You had the Amaranth story with Brian Hunter and $6 billion drawdown or loss there. Can you tease apart what probably was some of the challenges that these funds ultimately faced and therefore, what commodity hedge funds face?
A lot of these groups were very successful through that period. You come out of the GFC, and then I think, you had a lot of these groups struggle to generate the type of returns that they generated in the 2000s. And through that period, I think investors had a lot of different reasons why commodity hedge funds underperformed. I think the main reason or the main narrative that was expressed was that lack of informational edge, right? That information traveled much faster. So having that network of the physical markets, having access to, some pieces of data that others didn't, discontinued to exist.
And I think there was absolutely both the increasing availability of information, but also there is an argument, we'll come on to it, I think, that as these portfolio managers stepped away from their organizations, their Enrons and so forth, rooted in the physical markets, some of their knowledge and contacts dated a little. But there was also, looking at your notes, it wasn't just that informational edge. At that same time, you had the growth of managed futures, other market participants coming in, changing the nature of commodity trading as well.
Correct. So I think, by and large, the commodity hedge fund managers during the 2000s were discretionary, fundamental commodity trading houses, right? So these are, again, going back, these are guys that really had a firm understanding of supply and demand fundamentals. With the growth of assets in the managed future space, where, those strategies, if you just think of, trend following strategies, they don't care about supply and demand, right? They only look at price and, maybe derivatives of price. And so I do think you had some of those markets trade in a manner and in a size that was completely foreign to the discretionary commodity managers. I think from a risk framework, what that means is they were unable to hold on to positions. So, price would get so far away from fundamentals, they would have their own risk frameworks in place, and they wouldn't be able to hold on to positions that ultimately would settle on those fundamentals.
That was a common story we heard. I think that was especially prevalent in the last decade. So you've got two sources of challenges to these. There were certainly structural challenges in and around the time of the GFC that kind of stopped these outsized returns or slowed them. So you had commodity prices starting to go down. There was the rise of these different market participants attracted to the space through advances in technology and high frequency trading, but also just the returns that these organizations were making. And also regulation, right? We shouldn't remember that lots of there was a drive towards transparency in commodity trading as a result of the global financial crisis. They also face that entire other category of risk, which they're probably more exposed to than traditional asset classes like equities. Basically, any and every kind of event, whether that's political, weather, whatever it might be, can have an outsized effect on a commodity hedge fund. Because it's worth noting, the numbers still stagger. Like Amaranth, having almost half of the fund's assets risked on one trade to do with gas price spreads between winter and summer 2007. I know that's a bit of an anomalous case, but it's kind of extraordinary how risky commodities trading is because of its exposure to real world events.
Yeah, I don't know that risk in the commodity hedge fund space is really all that different from risk in, let's say, the equity space. If you look at what transpired earlier this year with GameStop, some hedge funds were on the right side of that trade and some were on the wrong side of that trade. I would point out that in the commodity space, there is event risk, whether that be, the effect that weather is going to have, the gas or power markets, geopolitical events, So if you look at in 2020, the Russia-Saudi oil price war, if you look at drone strikes, like these events are going to move the futures markets, and commodity hedge funds, may be on the right or wrong side of that.
Yeah, I think this is probably a fair comment to say that there are more global events on a daily basis, than there are sort of Reddit events, like.
Sure. And I would say a lot of these commodity managers, these markets are not as deep and liquid as the equity markets, right? And so there are fewer market participants. Generally speaking, market participants know who everyone is. And so if they catch wind that someone's on the wrong side of a trade, they're relentless.
Yeah. So you kind of ending the global financial crisis, commodity prices have collapsed. Let's say it's 2013. Most of those names that you previously mentioned
Out of
business or on the way to shutting shop. And it's quite stark, right? I don't know if any of those are actually still active funds.
It's funny. None of the funds that I mentioned are still active. Now, they closed at different points in time. I think they were largely successful, had their time in the sun, and I don't want to say couldn't adapt, maybe couldn't or weren't willing to adapt to a new market environment.
Yeah. Right. Okay. Well, let's understand a bit more about that market environment in the 2010s and what some of the themes you were seeing, both from investor expectations, types of funds out there, and frankly as well, this was a very the number of funds shrunk dramatically.
Yeah. So I would say, there was just a lack of narrative and opportunity set post GFC. Now, that's broadly speaking. I think in any market over a period of time, you may see certain opportunity sets, but broadly speaking, there was a real lack of interest from the institutional investor community in their allocations to the commodity hedge fund space during that period of time. I think if you look at, in our database of commodity hedge funds, the number peaked in and around the end of 2017, early 2018. And that is, probably just north of 120 funds. Now, this is of various sizes, but, you've seen now we're kind of at a low or just coming out of a low. There's only roughly 80 plus hedge funds that are dedicated to trading commodities.
That's quite a stark journey. Just help us understand a little bit. So the financial crisis ends. Are these institutional investors moving away from having commodities in their portfolio because the returns are so poor, or they significant losses, or is it more secular that in general commodities no longer have a role in portfolio theory?
I don't think it's the latter. I just think the performance of the space relative to other asset classes and other hedge fund strategies, it was really an opportunity cost, right? And so if the space is underperforming, if there is a lack of a narrative, or if the narrative is negative, like I stated before, that these discretionary fundamental managers who had an edge through their understanding of the physical and primarily through their network, if that edge eroded, what is the real rationale for an investment, right? These are, generally speaking, uncorrelated absolute return vehicles. And if there's limited return in the space, they're not going to deploy the resources to do the work to find out, okay, we want to put money in the commodity space because we think there's going to be a good opportunity set there. Who should we allocate to, right? I think that the space needs a narrative for larger institutional investors to devote the time and the resources to do the investment due diligence and the operation due diligence on funds in the space.
Yeah. And part of the challenge of that period, and I don't know whether this continues now, but people who did have an informational edge, a particular mousetrap or whatever it was that they knew really well that they could convert into decent and consistent returns, typically those strategies weren't really scalable, right? So you kind of were stuck at the 10, 20 million under management. They just couldn't get anywhere near that kind of vaunted $1 billion.
Yeah, although I would say, some of the sector-specific managers, they could certainly get north of that. But then it's, do they have the operational infrastructure that would meet the requirements of an institutional investor?
Yeah. So institutional investors weren't really interested. Obviously, it was a period of low volatility, low prices. But what else was, I just want to really dig into what else was going on that really meant that commodity hedge funds weren't able to give those kind of returns outside of more broad secular price shifts? Was it what's going on with risk and warehousing risk and what's going on with these long only funds and other high frequency trading and algorithmic trading that's limiting that opportunity?
I think if you look at the growth in managed futures and algo trading over the post-financial crisis period, combined with banks leaving the space, the whole environment drastically changed, right? So, leading up to that, you had groups that were really focused on market fundamentals and those fundamentals driving price. When you have algo trading and CTAs solely focused on price and derivatives of price, moving markets far outside of where supply and demand fundamentals would expect them to be. You have managers that are just forced based on their own risk constraints or risk constraints imposed upon them by their investors to exit positions, right? So they can't hold on to their positions. And then they have a hard time deploying capital into new positions, knowing that they may get stopped out. I think you used to have a number of funds with higher risk constraints. They were able to warehouse risk. You had banks that were able to warehouse risk. And when a lot of that liquidity evaporates from the market reacts differently than it had, call it from the period leading up to the financial crisis.
That's interesting because there's two elements that I want to dig into. One is typical of those hedge funds that had success in the 2000s, their leadership was, they were typically commodities experts themselves. And I assume that the money behind them was more willing to face some of those risks. How much does that play into this, which is if the traditional cross-asset class funds, commodities is quite a difficult asset to bring in, because it just has such different returns compared to what I guess the institutions that back them are looking to see.
I think you're exactly right. So I think, in that 2000 period, the investors in these funds were, largely speaking, high net worth individuals, family offices, fund of funds who allocated to these strategies as a portfolio component, an uncorrelated portfolio component, and one that had the capacity to deliver real absolute returns. I think as you had larger institutions enter the space with, call it a different appetite for risk, hedge funds needed to change the way in which they delivered returns to their end investor if they wanted to attract capital.
Interestingly, nothing's really changed there, right? Those are still prevalent and challenges today, even potentially arguably more so as these markets become more, as more CTAs come in. So the narrative out there since the beginning of the year has been about this commodity super cycle. What is going on amongst the institutional investors that you talk to, that you're directing towards various opportunities? Are you seeing interest from them? Can you give us some idea of what types of investors they are? Who's interested?
So we are seeing a renewed interest in the commodity space, I think, across the board, from high net worth individuals to family offices up to public and corporate pension plans. Some of that capital is slower to move. So I would say, Q4 2020 into the first quarter of 2021, we saw allocations from primarily the family office space, I would say the asset management space, as well as, some corporate pension plans. The public pension plans, their allocations are primarily driven by the consultants. And the commodity hedge fund space is one that really isn't broadly covered by the investment consultants. So we've started to see at the end of last year and beginning of 2021, consultants coming back to the space, meeting with hedge funds, trying to get a sense of who's still out there, who's doing what, who's raising assets, so that they can relay that information to their client base. So I think you will see public plans allocating capital to this space We are certainly talking to groups who are looking to allocate to this space. And, I think those allocations will come in size towards the end of 2020. I think those allocations will come in size towards the end of 2021.
What has changed in terms of the suite of types of funds these organizations can invest in now compared to that 20 years ago?
Look, I think the funds now have a real understanding of what institutional investors require of them, right? So I would say, early in the 2000s, those groups, those hedge funds delivered returns, and it was a very opaque industry, Paul, right? So, outside of some of the larger groups, like they didn't post their performance to databases. They didn't have huge marketing teams out there soliciting investment from institutions. It was more of a, you probably had some of the bank cap intro teams covering them. But, if you wanted to invest with, let's call it a gas manager down in Houston, you would go down to Houston, you would make the rounds and decide, who you wanted to allocate to. It's always been a very opaque market and continues to this day. I think, when these managers are trading in, a specific market or a specific set of markets that is relatively thin, they don't want to put a lot of information out there on what they're doing, what their performance is, because that's just one additional piece of information that may fall into the hands of a competitor, and they don't want to tip their hand in any way.
Yeah. I just want to go back to something you mentioned. So you mentioned there was kind of this peak in 2017 and of numbers of funds, and now you're down to about 80. There's quite a cliff, though, as I understand from you, in terms of assets under management. I mean, you get very quickly to very small funds.
Correct. So if you look at our index, the Bridge Alternatives Commodity Hedge Fund Index, which we launched in 2014, that index is comprised of the largest 15 managers ranked by assets under management that trade commodity futures, right? And so, I think at the top of that list is a manager that manages just north of $2 billion in a diversified portfolio. I think the 15th manager is $250 million, right? So there is a big gap between the top manager in that index and the 15th manager in that index. Now, the index does not comprise, there are certainly some managers that do trade commodities that aren't in the index, but I think overall it's a kind of who's who in the commodity space. So of that 80, I would probably say 25 to 30+% have assets greater than 100 million. A lot of the managers are trading with assets less than 100 million.
There's lots going on in the commodities world at the moment, driven by, we think about kind of the commodity supercycle story as one of potential inflation. You've got energy transition. You've kind of got with all of the investment in renewables, batteries. It's a big story about metals. It's not so great a story about hydrocarbons. You've kind of got the pandemic pointing out kind of the fragility of supply chains. The broader narrative about whether trading blocks will seek to sort of find alternative sources for crucial national interest raw materials. Are you seeing institutional investors say, look, I want exposure to this market to hedge against this or to be part of this story? Is there that kind of segmentation going on in the funds where we'll make you money, but we're also going to provide you exposure to energy transition, exposure to whatever it might be?
For sure. I think you nailed it, Paul. So, we're seeing interest across the board for all of the reasons that you mentioned earlier, right? So, whether it's the inflation narrative, you'll have groups looking to allocate to managers in an active long-only fashion, maybe as an inflation hedge. If it's the renewable story, if it's a supply chain issue, it's you will see investors who have dug on to one of those themes and then are looking to express their view in a manager that will kind of focus on that theme. So in renewables, maybe it's in the metal space, right? So, not only do you have the macro inflation story, but you have all of these kind of, I don't call them micro fundamental stories, but maybe market specific narratives that are really driving performance and driving investor interest.
Yeah. And are you seeing kind of a more savvy marketing from, or is there the need for these, whether it's a startup fund or established funds, understanding that dynamic and being a bit more savvy than perhaps 20 years ago, where it was just simply, here's my returns and don't worry about it?
Yes and no. I mean, I think the groups that have survived have never really put a real importance on business development. It is more, look, if we deliver performance, the market or market participants will find us, investors will find us, and we will raise assets. That is a broad generalization. I think it's accurate relative to other hedge fund strategies. However, we are seeing different types of product in this space, right? So you are seeing some institutional investors are interested in smart long-only funds, right? So relative to, I think, leading up to the GFC, you did have a lot of institutional capital invest in, let's call them passive commodity indices. And those were susceptible to contango in the forward curve. So, I think in this cycle, you may see some of those groups who want long-only exposure to the commodities invest in either kind of smart long-only or active long-only funds. There is where the groups are paying attention to the forward futures curve. Some institutional investors feel like they get commodity exposure through their allocation to the CTA space, whereby, some percentage of that portfolio is actively participating in medium to long-term trends in the commodity space. And then we're seeing groups allocate to whether it be diversified commodity hedge funds or sector-specific commodity hedge funds, or even market-specific commodity hedge funds, where someone is just investing in a hedge fund that trades North American natural gas. And then I would say, finally, you will see investors allocate to real assets, timber, water, some type of merchant shop where you're going to get exposure to natural gas pipelines or crude pipelines.
Yeah. I want to sort of interject and just say, alongside investors getting reinterested and excited about the space from all different backgrounds, also we're seeing, and have actually seen for a few years, but I think it's really starting to hit a tipping point of these broad multi-strat asset class, I don't know what the terminology is, hedge funds, also looking to get commodity portfolio managers in as well.
Certainly. And I think that is as you point out, is a real driving force of allocations over the past, call it 12 to 18 months. I mean, I remember seeing Ken Griffin speak in an event in Chicago in the fall of 2018, and he was super excited about the opportunity set in the commodity space, right? So you have seen the likes of Citadel or Millennium or their peers bring on teams in-house where, maybe historically speaking, those were groups that may have set up their own fund and attracted outside capital. So I think you are going to continue to see a dearth of talent in the commodity hedge fund space for a period of time.
Absolutely. We'll come on to that. So I guess, can you give us some sense of scale? Where are we at right now in terms of, roughly speaking, assets under management in commodities in your index, and where do you think we might get to in the next couple of years?
Our index represents over $10 billion of institutional assets in commodity hedge fund space. So again, that's the top 15 commodity managers ranked by us.
Not including those big funds, the multi-strategy
right.
funds.
So that's it. That's just 10 billion commodity-only standalone hedge funds in our index, right? That is not the whole space. I couldn't even venture to say how much is in commodities, but so let's just say the top 15 managers by assets under management command over $10 billion in assets.
So where do you think we might get to?
I think you could see multiples of that, right? And so what we don't have insight into is that doesn't include discretionary global macro or CTAs. That doesn't include some of the multi-strat hedge funds that you had mentioned earlier. That doesn't include a lot of the long-only or active long-only commodity funds that are out there. So I do think certainly is more capacity in this space. I would warn institutional investors, though, that a lot of the funds in our index are limited capacity funds, like I alluded to earlier. So, these guys that, have stated that they are going to close at some number, call it 800 million, 900 million, a billion. If one or two large institutional investors come along and allocate, those funds are closed.
Yeah, it is that's the whole point in some ways, is that actually these are quite limited opportunities. I guess to wrap things up, we alluded to those challenges in the 2010s, and at least a couple of those were structural. You certainly had that capacity challenge, but you also had the issue of other market participants driving pricing away from the fundamentals, at least in the short term. And you have kind of the issues around warehousing risk and so forth. Will those issues go away in the next commodity super cycle, or is the heyday of hedge funds over compared to what was going on in the 2000s?
I really don't think so, Paul. I think those challenges will persist, but I do think that the hedge funds that, I would say, the new launches that we've seen over the past 2, 3, 4 years, while they have been limited, most of them find that market behavior to be constructive, right? So I do think there is, I don't want to call it a new style of trading, but maybe kind of a new guard that is very aware of the impact that CTAs or other market participants have on price, and have figured out ways in which to either to take advantage of that or mitigate that risk.
Yeah. Yeah, and I think the challenge actually comes down, if I had to think about the capacity constraints, you've alluded to it, it's actually about the talent, because that's the thing, has followed the same curve as the hedge funds, except, whereas it takes a couple of days to set a hedge fund up, being facetious, it takes 5-10 years to create a fantastic commodities trader who has that blend of physical, financial, risk management capabilities, who could actually, he or she, return the kind of returns that these institutional investors expect.
Correct. So I think two things I would point out there is what we alluded to earlier. You are seeing some of the multi-strats hoover that talent up. I would say, another point that I would make that we're really excited about is we are seeing talented portfolio managers look to launch their own hedge funds, whether that be, traditional kind of hedge fund structure or taking capital in via separately managed account, whereby, it's limited capacity, right? So, they can generate a reasonably high Sharpe ratio, call it north of 1, sometimes north of 2 or 3, but only trading $100, $200, $300 million in capital, right? I would say, unlike kind of the traditional hedge fund structures or hedge fund businesses, these are 2, 3, 4-man shops where the IP resides with the traders, the researchers, right? It's just a team that is solely focused on research and trading. Maybe they have one ops person and they outsource business development, or they outsource middle and back office. And usually speaking, they're going to set up fees that align their interests with the investor's interest.
Yeah.
And those may not be the best opportunities for the public plans. Those are probably more opportunities for whether it be multi-strats that will allocate externally, high net worth, family office, fund-to-fund crowd.
Which we've also actually seen. So we're definitely seeing that as well. And you and I have collaborated on that. You're definitely seeing, if you go back to the 2000s, that was the kind of money that was probably more suitable, at least at the time, to those types of organizations, right? They were more willing to to manage or to accept that volatility for the outsized returns they knew they could get.
Yep. And so, those are the same investors now that I think are earliest to allocate to the commodity space. And quick as well. We are seeing groups who they want to deploy risk in the commodity space. They want to know who all the managers are and who the best of breed are across sector, and are moving very quickly.
Yeah. It's still a challenge though. That's still a relatively small talent pool. That's also, it's fair to say, a talent pool that, if you look at the narrative of a hedge fund over the last decade, which is in many cases their horizon, it wasn't a great story. Their colleagues that did get plucked by a small fund 5 years ago might have had a pretty rough ride of it, whereas they staying at their physical shop or organization have earned consistently more and had less career risk as a result, right? So I think there's also you've got kind of an activation level energy to overcome for people to start believing that story is a viable career path. Just given the experiences of the last 10 years, and a part of hopefully what this podcast does as well is remind people that, if you expand your horizon to 20 years, it's quite a different story.
Sure. So I do think, if you look at our index, fantastic performance in 2020, we're off to a great start in 2021. So I think, we're starting to see capital follow suit. And then if the narrative continues where you do see continued hedge fund closures, not because of poor performance, but because they're closing at levels that they had initially communicated to their investor base that they were going to close at for capacity reasons, my hunch is you will see more groups or teams leaving trade houses and trying to take a crack at launching their own business.
Yeah, absolutely. And now they know who to call. Well, thanks very much for joining us, Ryan.
Thanks, Paul. I appreciate it.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify. To find out more about HC Insider and Human Capital, a search firm dedicated to the commodities sector, go to www.hcinsider.global, where you'll find more original content on the commodities sector and more details on our offering as a search firm and our locations around the world. Thanks again for listening.